What an absolutely great question we have here. So it says that Park Company's wholly owned subsidiary Schnell Corp maintains its accounting records in German marks, right? So Schnell is the foreign subsidiary, Park is the parent company. So the question then goes on to tell us that all of Schnell's branch offices are in Switzerland, right? So their functional currency is the Swiss franc, right? When we think about the functional currency, that's the primary currency used to do business, right? Revenues, pay employees, pay suppliers. Right? So functional currency here is the Swiss franc, but they maintain all of their accounting records in German marks, right? So we'll have to figure out what to do with that. Now, when we think about remeasurement and translation, let's bring up the visual, right? Because basically you have local currency that needs to be converted to functional currency. So Schnell is basically saying, okay, we have our accounting records in German marks, but our functional currency is the Swiss franc. So we need to remeasure our accounting records to convert them into the functional currency, which is the Swiss franc, right? And then after that, once we have our statements in the functional currency, we then need to translate these statements to be in US dollars, right? For when they're consolidated with Park in the consolidated financial statements, right? So there's two steps there. So it's important that we understand that, because then the question tells us remeasurement of Schnell's year 4 financial statements resulted in a $7,600 gain, right? So when we think about remeasurement, right, any gains or losses, those go to the income statement. And that's because, again, we were converting the local currency records to the functional currency of the Swiss franc. Now, it then goes on to tell us translation of the financial statements resulted in an $8,100 gain. Right? But under translation, that goes to other comprehensive income and not the income statement, right? Now, the question is asking, what should Park report as foreign exchange gain in its income statement, right? Well, what type of activity gets recorded in the income statement? In this case, it's only going to be remeasurement gains and losses, right? Not the translation gains and losses. Those go to other comprehensive income. Right? So only the $7,600 gain is going to hit the income statement for Park. Right? The rest of it's going to be captured in OCI, which is part of stockholders' equity on the balance sheet. Remember our FUPI mnemonic that helped us remember what goes in OCI, and that's the F, right? So the correct answer here is going to be $7,600.
What's going on? My name is Joey, and I'm the founder of Universal CPA Review. You're probably here because you're ready to pass the CPA exams once and for all so that you can advance in your career and move on with your life. Let me be the first to tell you that I've been there and I feel your pain. But I'm also here to tell you that the CPA exam doesn't have to feel like such a maze, and there is a path to a passing score.
So what does the question want us to answer, right? It wants us to answer the year-end balance for total equity. What is it? And we know that there's quite a few items that impact equity, right? For retained earnings, we have net income and net loss, as well as any dividends paid. And then if there's any stock dividends, that impacts retained earnings, as well as total stock outstanding. So what I recommend is we go ahead and create a equity roll forward, right? So we'll start with equity from the prior year. That'll be our beginning balance, and then we'll factor in any items throughout the year, sum those up, and then we'll have our total impact, and that will get us to the total equity at the end of this year. So actually in the bottom left, I've got the equity roll forward that shows the correct answer is $360,000. Now, keep listening, right? Because I want you to understand how the various items actually impact the equity roll forward. So as you can see, what we need to start with is our beginning balance for equity. Now, the question doesn't give us the equity balance from the prior year, but it does give us the year-end assets and the year-end liabilities, or which become the starting point for this year, right? So as you can see in step 1, we can solve for beginning equity by subtracting liabilities from assets. So we have assets of $600,000, subtract the liabilities of $400,000, and that means equity is $200,000, right? Because that's the only way that liabilities and equity can equal assets. So our starting point is going to be $200,000 of equity from the end of last year, which becomes our beginning balance. Now, the next thing we need to do is factor in any net income throughout the year. And it says that the company uses the accrual method. So we can kind of ignore what our cash income and cash expenses are and just focus on the accrual type method, right? So it says we had sales on credit of $250,000 and then we incurred expenses of $90,000. So those are the two numbers we need to use for accrual accounting, right? We don't really care about what's outstanding because if it's been recognized, that means it's in accounts receivable until it's collected. So we don't have to worry about the $8,000 that needs to be collected. And then we also don't really care about the $72,000 paid in cash, right? Because we incurred expenses of $90,000. So under the accrual method, that's what our expenses are going to be. So as you can see in step 2, we just take credit sales of $250,000, subtract the expenses of $90,000, and that gives us net income of $160,000. And since we have positive income, that's going to increase our retained earning balance. And honestly, that's going to also increase our equity balance. So you can see in the bottom left, that's plus $160,000 for net income generated during this year. So the last item we need to evaluate is any stock dividend, right? Well, when it comes to a stock dividend, that just increases the number of shares outstanding, but there's no impact on total stockholders' equity, right? But there is an impact to retained earnings. So the visual does show us those impacts, right? So you can see how it decreases retained earnings, and that's because any retained earnings pays for a stock dividend. But then we also increase the common shares outstanding for the same amount. That's why there's no impact on total stockholders' equity, right? Because retained earnings and common stock outstanding are both part of equity. So we don't actually need to factor in anything for the stock dividend. So all we're left with is the current year net income of $160,000. So if we add that to the beginning balance of $200,000, that means our correct answer is $360,000. That's the year-end balance for total equity. So Las Vegas Entertainment, they're going public this year, or at least they incorporated, right? Let's hope they went public. I'd love to invest in that company. Now, they issued 10,000 shares on January 4th at $7 per share. And the question wants to know, how much cash did Las Vegas Entertainment receive when they issued that stock? Well, the company is always going to record cash from that sale at the cash that they received, right? It makes sense. So when the stock is issued, we would just take the number of shares that have actually been issued, which is the 10,000 shares, right? They only issued 10,000 even though 20,000 were authorized. So take the 10,000 times the price per share that they received, which is $7, and that means they generated cash from the issuance of that stock of $70,000. So $70,000 is the correct answer. Now, as we love to do here at Universal, let's keep rolling and round out the question, right? So what would the journal entry be when they issued that common stock? Well, since they're receiving cash, they're going to debit cash for that $70,000. And then we know the credit goes to common stock and possibly additional paid in capital. So for common stock, it's based on the par value, and the par value of that stock was $5. So $5 times 10,000 shares, that means $50,000 is credited to common stock. And then additional paid in capital, right? That's the excess that investors are willing to pay above the par value. So they paid $7, the par value is $5. That means $2 per share times 10,000 shares. Additional paid in capital is credited for $20,000. So there's the journal entry, right? So we've rounded it out, and now you know exactly how to record entries when common stock is issued.
So what are you waiting for? Don't waste any more time. Commit to the process because it will pay off. In my opinion, I say let's knock out the CPA exams once and for all.
So Pebble Beach, they were formed in year 1, right? And then they had the following transactions. Now, if we dip down to the last sentence of the question, it's asking about what to record for the treasury stock that was purchased on July 15th. So let's focus just on that, right? Because what we need to do is understand the journal entry and whether they use the cost method or the par method, right? Because that impacts the type of entry that we would record. So as you can see on the screen, we have the cost method and the par method. Well, fortunately, the company is using the cost method. And under the cost method, you record that treasury stock at the repurchase cost. So this is the quite simple method. Fortunately, they're not using the par method because that method's a little more difficult. So since the company repurchased 5,000 shares at $16 per share, we just need to figure out how that relates to the cash outflow, right? And then our debit is going to be to treasury stock. So as you can see in the visual, if we take the 5,000 shares at $16 per share, that means the total price to repurchase those shares of stock was $80,000. And since they're buying them from the general public, that's a cash outflow. So we credit cash for $80,000 and we debit treasury stock for that $80,000. So the correct answer is debit to treasury stock for $80,000. So this question is focused on understanding how transactions that occur throughout the year ultimately impact the number of shares outstanding for a company, right? So we should think about creating a outstanding stock roll forward. So we always start with the beginning balance, which in this case is going to be the ending balance from year 3, which is 300,000 outstanding shares. Then there's 4 different dates of which transactions occur, and we need to figure out what the impact from those will be. And then whatever happens, we sum to our ending balance, which is going to be the number of shares outstanding at the end of year 4. So for the exam, there's really 6 different types of transactions that ultimately impact the number of shares outstanding, right? Some increase the number of shares and some decrease. So we'll keep this in mind as we go through each of the 4 transactions. And I'm going to go ahead and flash up the roll forward for the outstanding stock because I think it's going to be helpful to see how that ultimately flows in when we talk about specific transactions. So on the first one, the company declared a 10% stock dividend. Well, what we need to know is that stock dividend is based on the number of shares outstanding on January 31st. So since nothing's happened so far, those 300,000 shares at the end of year 3, that's going to be our base. And we multiply that by 10%, and that means that 30,000 shares are issued from that stock dividend, right? So now we have 330,000 shares. Then on June 30th, the company purchased 100,000 shares. So presumably they bought those off the open market. So when a company repurchases shares they recently issued, that's called treasury stock. And that's actually going to decrease the amount of shares outstanding. So that is going to be number 3 in our visual, the repurchase of stock. And that now is called treasury stock since the company owns their own stock. So after the transaction on June 30th, we now have shares outstanding of 230,000 shares. And then on August 1st, they reissue 50,000 shares. Well, when they reissue, that means they sell them back to the public. So that's going to increase the shares outstanding by 50,000. And now we have shares outstanding of 280,000. And then on November 30th, they declare a 2-for-1 stock split. Since it's a stock split, we multiply it by the leading number, and that's 2. So we can take the 280,000 shares, multiply by 2, and now we have 560,000 shares outstanding, right? Because we basically doubled the amount of shares. And that's the last transaction of the year. So that means on December 31st, year 4, Trout Corporation had 560,000 shares outstanding. So that's the correct answer.